My man, what's good? Hey, check it out, bro. I just bought a boatload of PayPal stock. Yeah, they got this new CEO. Earnings are up like 20% this year, and yet the stock is down. It's trading for like 11 times next year's earnings. Looks super cheap. I'm pretty confident I'm going to double my money on this one pretty quickly. Bro, are you serious right now? Listen to me carefully. Everyone knows that PayPal is a value trap. Who even uses PayPal anymore? You got Apple Pay, Google Pay, Cash App, credit cards, literally anything else. Dude, no, just look at the chart. That is a falling knife. You really want to catch that falling knife? All right, man, have fun staying poor. If you're anything like me, you love hunting for bargains in the stock market, and that might have led you to buy some PayPal stock this year. But you've been watching it underperform, and so now you're having this debate with yourself or other investors about whether or not PayPal stock is a good holding or just a value trap that's gonna bleed out. So today, I'm gonna present the bull case and the bear case on PayPal stock, and I'll give my own opinions on where I think the stock is headed in the coming years. All right, let's dive right in. As you probably know, PayPal is a global brand and one of the largest payment companies on earth. It's a publicly traded company with a market cap in excess of 60 billion, but the last few years have not been kind to PayPal stock. PayPal stock is down more than 60% over the past few years, and 2023 has been no exception. PayPal stock currently down about 18% year to date through early December. It's the 8th worst performer in the NASDAQ 100 index so far this year, and that's during a year when a lot of large cap tech stocks have done very, very well. So it seems like the bears are currently winning the battle. But bulls see this as an opportunity. Bulls are seeing a stock that's trading at 11 times next year's earnings estimates, which is a big discount to the overall market. And I see them making comparisons to the Meta situation from a couple years ago. Meta stock was also down 60% at one point during 2022. Investor sentiment had soured. A lot of investors thought the business would shrink. And yet, if you kept the faith, you'd be up a lot. Meta stock is up a couple 100% this year as the business has stabilized and investor sentiment rapidly improved. So a lot of PayPal investors think the same thing could happen at PayPal. Now, bears will counter and say that PayPal is no Meta. PayPal is destined to shrink, that earnings will be lower in the future. Therefore, the stock is not as cheap as it looks. It's a value trap. So who's right, bulls or bears? To start to answer that question, I think it's really crucial to understand that PayPal, the business, is actually 3 distinct businesses within the overall business. Now, your average investor, your average YouTuber doesn't probably go into this level of detail, but I think it's really important to understand what the future looks like for PayPal because each of these business units has a very different growth rate and trajectory and a very different margin structure. So PayPal you probably associate with the branded checkout or digital wallet side of the business. This is the traditional PayPal business, the PayPal buy button that you see on e-commerce websites that you can use to buy goods and services. Maybe you've used the traditional PayPal to send money to friends and family from your PayPal wallet. And currently I estimate this makes up about just over half of PayPal, the company's total process volume. PayPal, the company, processes about $1.5 trillion worth of payments every year. And this branded checkout business does just slightly more than half. Now, Braintree is PayPal's unbranded or B2B processor. PayPal, they process payments for companies like Uber, Airbnb, Adobe, Live Nation. They do this behind the scenes. You don't even know you're using Braintree or PayPal. But PayPal is a big player here. Their competitors include Adyen and Stripe. But this currently makes up about 30% of PayPal's total process volume. As you might imagine, in the Braintree business, PayPal charges its large clients a preferred rate, a lower rate than it would in its traditional business. So it only makes up about 25% of revenue, still significant, but not nearly as large as the traditional core business. Then there's Venmo. A lot of people don't realize that PayPal owns one of the most popular peer-to-peer payment apps out there. Venmo has more than 90 million global users. You've probably used it to send money to friends to help pay for dinner. And Venmo actually makes up 18% of PayPal's total process volume, but it's very under-monetized. It only makes up about 5% of revenue by my estimates, because a lot of those small transactions, PayPal doesn't take any fee on. They will take fees on certain types of transactions with businesses and also for instant transfers to bank accounts and things like that. So these are the 3 main parts of the overall business. Now let's zoom back out and look at the financial performance of PayPal, the company as a whole, in recent years. So this is a chart showing PayPal's total revenues as well as operating profit over the past few years. These charts are up and to the right, not necessarily what you'd normally associate with a stock price that's done the opposite, that's been in decline. But PayPal has grown at a pretty nice clip, its revenues and operating profit. And PayPal during the pandemic really saw heavy growth. It saw an acceleration in its growth rate across the business. It was at one point growing over 25% a year during the height of the COVID boom when e-commerce was booming. But we have seen those growth rates tail off. But still, PayPal is growing. If we look at the year-to-date metrics in 2023, through the first 9 months of the first 3 quarters of the year, PayPal has grown revenue by 8% year over year, operating profit by 12% year over year, and earnings per share growth of 26% growth year over year. A very, very strong number for a company of this size. Even in Q3, we saw growth as well. Revenue grew 8%, operating profit grew 8%, and earnings per share grew 20% in the most recent quarter. PayPal is also guiding to further growth in the fourth quarter of 7% revenue growth and 10% adjusted earnings growth. PayPal will also produce about $4.5 to $5 billion of free cash flow this year, so it's a very profitable and cash flowing business. And the company has about $5 billion of net cash and investments above the level of debt on its balance sheet. So not really a performance that you would associate with a stock chart that looks like this. However, we have seen a lot of other stocks make this similar pattern. Stocks that boomed during COVID, where investors got over exuberant and bid these stocks up to crazy valuations, have seen a lot of these stocks come crashing down. So it's not necessarily just a PayPal issue that people got, way too obsessed or maybe too optimistic about PayPal. This also happened with a number of other stocks out there during COVID. You see a very similar chart pattern. Now, some of these other stocks have started to recover a bit faster. Important to keep that in mind, but certainly PayPal is not unique in seeing this type of pattern play out post-COVID. And if we look at valuation charts of PayPal, even excluding that COVID period where things got really bananas, PayPal is now trading at its lowest valuation as a public company ever on most metrics that we look at. So if we look at price to earnings multiples, or we look at enterprise value to EBIT multiples, any valuation metric really that you want to look at, if you chart it over time, you'll see that PayPal is trading at some of its lowest levels ever. We could even look at statistical measures like the percentile ranks of the current valuation multiples. Price to earnings is currently trading at its 2% relative to history, percentile rank wise. And so if you look at really any of these metrics, you'll see a similar thing. PayPal's trading at its lowest decile of valuation metrics pretty much ever. So with the performance in the financials having a big mismatch with the stock and the valuation, the question is why? What are the cracks in the story? So I compiled some key metrics from PayPal's quarterly financial statements to illustrate some of the cracks in the story. Things like active accounts, transaction processing volume, revenue, gross profit, operating profit, etc. And if we look at active accounts, for instance, this was reported as 428 million active accounts across all PayPal business units in the third quarter of 2023. That's versus 431 million in the prior quarter and versus 432 million in the third quarter of last year. So there's been a little bit of slippage in active accounts. That, of course, could be a concern, although it's relatively small. And we've also seen the total process volume continue to grow as well as revenues. So they may have slightly fewer accounts here in the most recent quarter, but it hasn't stopped the total volumes of their existing account members from growing a lot, and therefore revenues still growing. But when we look at gross profit, or what PayPal calls transaction margin, an interesting story emerges. So PayPal defines transaction margin as their total net revenues minus the direct transaction expenses minus the transaction and credit losses. So these two lines here, and I plotted that here, you get ultimately gross profit. And you can look at this from gross profit dollars or the percentage margin, the gross profit divided by total revenues. And I've done both here. And again, PayPal calls this transaction margin. We would normally call this gross profit or gross profit margin. So if we look at the percentage margin, it has been in a steady decline for the better part of the last 4 quarters. That would potentially be a concern. But what we also see is when we compare the gross profit dollars, 3.369 billion in this most recent third quarter versus the third quarter last year. Last year, it was 3.491 billion. So there's actually been a decline year over year in the gross profit dollars. Now, why is this a concern? Let's look at some illustrative examples. Normally, I don't care too much if the gross margin percentage declines a little bit if you're still adding gross profit dollars. And now what do I mean by that? Let's say you have an existing business with a bunch of existing products that you're selling. Let's say you generate $100 of revenue, and after paying direct expenses, you're left with $50 of gross margin dollars. So you take your 50 divided by 100, you have a 50% gross margin. Great. Let's say you introduce a new product that you expect customers to pay for in addition to your existing products. And that new product will also generate $100 in revenue, but it has a lot more direct expenses associated with it. So the gross margin dollars you're left with after expenses is only $20. So your gross margin percentage on this new product line is only 20%. So you have a existing business doing 50% margins, and you have a new business doing 20% gross margins. And so ultimately the combined business is going to generate $200 of revenue, which is this plus this, and then $70 of gross margin dollars. Your 50 from before plus your $20 of new gross margin you're now generating from the new products. Now, if you take this 70, you divide by the 200, what you have here is a new gross margin percentage of 35%. So what has essentially happened is you've added incremental gross margin dollars from the new product, but it's at a lower margin. So ultimately you have more gross margin dollars, but you have a lower gross margin percentage. So you went from 50 to 35, but ultimately you went from $50 of gross margin to $70 of gross margin. So this is a good scenario, typically. Like you might have lower percentage margins, but in the end, you're making more gross margin dollars that are available to pay operating expenses that hopefully will fall to the bottom line and become profit, etc. And that is fine. If you see a decline in gross margin percentage, but gross margin dollars is still growing, all good. But that's not what we're seeing here with PayPal. What we're seeing is gross margin dollars actually declined year over year, and we're seeing the percentage margin decline. Now, what does that imply? What that implies is one of two things. What could be happening is you've got PayPal's existing business, which is very profitable, and some of the new businesses that are growing, things like Braintree, which we know is growing very, very fast based on management comments. Management has said Braintree volumes are growing faster than the overall core business. So what could be happening is if you have an unprofitable business, what happens there is when you add unprofitable gross margin, if you have something that's earning actually negative gross margin dollars where your expenses are higher than your revenues, then that can dilute the existing gross margin dollars from the existing business. So what you would have is growth in revenue, but a decline in gross margin dollars. So that is one scenario. What could be happening is the businesses that are growing within PayPal are actually unprofitable and therefore bringing down the overall gross margin dollars in the business. That's one scenario. Another scenario is that maybe your new products or your faster growing business lines do still generate positive gross margin dollars. But what is happening is your core existing business is shrinking and it's getting worse over time. And that could also be what's happening here. What could be happening is the business that used to generate $50 of gross margin dollars is now generating $20 of gross margin dollars. And even though you're adding incremental gross margin dollars from the new business, it's not enough to make up for what you lost in the existing business. And so ultimately you're left with lower gross margin dollars at the end of the day. So that is what could be happening at PayPal. What could be happening is Braintree is growing really fast and it generates lower margins. And in addition, the core business could also be shrinking in terms of gross margin dollars. And that's what's ultimately leading to the overall decline in gross margin dollars at PayPal. So I know this is a little bit confusing, but this is one of the key things that's happening financially with PayPal that bears are pointing to and saying, oh, see, the core business is not in good health, or the traditional business is losing profitability. And that is really one of the key tenets of the bear thesis, because what the bears will say is that as we look out into the future in the years ahead, this is going to continue. And remember what I said, or what I showed earlier with the different business units. Remember how much the traditional core business makes up as a percentage of revenue, and certainly as a percentage of profits as well. So if that part of the business really starts to shrink and profitability gets worse, these two businesses, which are growing fast, may not be able to make it up quick enough. So what you may have is an overall decline in overall PayPal, even if Braintree and Venmo are still growing very fast and improving their profit margins. So that's really one of the big bear scenarios. So this is the melting ice cube scenario where bears are saying basically that the core PayPal digital wallet and core PayPal checkout button are seeing a decline in gross profits and potentially eventually down the line, maybe even a decline in processing volumes and revenue. Now, why would that be happening? The primary reason has got to be competition, and particularly accelerated competition from newer players like Apple Pay and Google Pay in the payments ecosystem. PayPal's always had to compete against credit cards and other forms of payment, but just in the last few years, we've seen an explosion in things like Apple Pay and Google Pay, especially in areas like mobile checkout. And that's because they have a significant user experience advantage. Rather than having to enter all of your address information and credit card information, you can check out on a site that has enabled Apple Pay or Google Pay with a couple clicks on your phone. And so that has led to Apple Pay and Google Pay getting significant share relatively quickly in the online payment market. And actually, if you look recently, Salesforce put out a report on the most recent Black Friday and Cyber Monday, huge shopping weekends, but they put out data showing that Apple Pay and Google Pay gained massive share over those recent holiday weekends, and PayPal actually lost a little bit of share of payments. And so that is a significant problem for PayPal that's not just going to go away anytime soon. And that affects their most profitable and largest part of the business. So the next question you might be asking is, well, Travis, how is PayPal growing earnings per share at 20% or more this year if gross profit dollars are not really growing very fast? The answer to that is that PayPal has been cutting operating expenses pretty aggressively. Here in these blue bars, you can see the operating expenses. Operating expenses are those expenses that fall below the gross margin line. Things like sales and marketing costs, tech and development costs, general and administrative costs. These are your corporate overhead costs. And those have been cut pretty aggressively by PayPal this year. And so you can see here in the orange line, the operating profit margin has been increasing despite the fact that gross profit margins have been decreasing. The other thing that has helped drive up earnings per share growth is the buybacks. The share buybacks that PayPal has been doing this year probably makes sense when your valuation is this low to be allocating capital to buybacks and reducing your share count, but that has certainly been putting downward pressure on the denominator of earnings per share and helping the overall earnings per share growth go up this year. Now, the question is, are these things sustainable? Can PayPal keep cutting operating expenses? Can they keep doing buybacks? And if you're an investor trying to figure out what PayPal is going to earn a couple of years from now, can you really depend on these? At some point, a company can't typically keep cutting operating expenses. Now, PayPal has said they do expect there's more they can do in the near term, but on a multi-year basis, you wouldn't expect these levels of operating expense cuts to necessarily continue. Most companies can't keep cutting forever. And indeed, if you look at the analyst estimates of earnings growth in 2024 and 2025, analysts currently estimate that PayPal's earnings per share growth will come down to 11 or 12% in the next 2 years versus the 20+% we saw this year. Now, if PayPal can hit 11 or 12% earnings per share growth in the coming years, that would still be pretty good. But clearly, there's also some skepticism in the market right now that PayPal can even hit those levels. So how do PayPal bulls respond? PayPal bulls will tell you they're still optimistic that PayPal can grow in the years ahead despite competition, despite the current challenges. And one thing that gives them optimism currently is that PayPal has a new CEO and CFO that they just brought in to re-energize the enterprise and drive innovation and growth going forward. The new CEO, Alex Chriss, comes over from Intuit, where he focused on small businesses. And the new CFO, Jamie Miller, comes over from E&Y. And management is similarly optimistic. They have said that our assets and our position in the market are incredible. We know exactly what needs to be done. We simply must execute. So what are the growth levers that PayPal can pull? Well, if we look at these growth levers by business line, I've listed some of the major ones here. So if we think about the core business, one of the more challenged parts of the business, the PayPal checkout and digital wallet, how can that part of the business reverse potentially what has happened recently with market share loss? One area, and I think that Alex Chriss is well suited for, is focusing on the small and medium business market. PayPal hasn't done the best job of coming out with solutions for SMBs. They've done a really good job on the consumer wallet side, and they've done a good job with Braintree at the large enterprise side. But in the middle, you've got many thousands of small businesses who may not be using PayPal products today that may be able to use them if PayPal could make it more user-friendly. And so PayPal has been working on what they call PayPal Complete Payments, or PPCP, for a couple of years now. And they have been rolling out elements of this, but this is meant to be a new checkout product, a Stripe-like product for SMBs that PayPal is going to offer and go to market with in a more aggressive way in the coming years. And again, I think Alex Chriss, coming over from Intuit, understands some of the needs of SMBs, and this could be an area where we see PayPal do better in the near future. PayPal can also focus on using data to personalize checkouts to make their buy button better versus competitors. Now, you're probably not going to beat the integration, the native integration that Apple Pay and Google Pay have on mobile phones, but there's still a lot of commerce. About 40% of all online online commerce is still done on desktops and laptops and not on mobile phones. And so that's an area where PayPal still has market share potentially to gain. And by personalizing checkout, by making checkout more seamless, by making the customer experience better, there's a potential for PayPal to grow there. PayPal also bought a company called Honey a couple years back for $4 billion. Honey is a company that focuses on rewards. It's a browser extension that helps you find discounted prices on items across the web. PayPal really hasn't done enough with this asset, and they probably, frankly, overpaid for Honey, judging on what it's generating now for PayPal. But this is still an area that PayPal can grow in if they could refocus and integrate that product a little better into some of their existing products. So rewards is an area where PayPal might have some potential still. Of course, you also get tailwinds in overall e-commerce growth and overall price inflation. Also, there are areas of the global economy, particularly in the Eurozone, where the economy's been weak and could recover in the coming years. All of that will only help e-commerce volumes grow, and thereby PayPal's revenues could grow because of some of these tailwinds. And that's what makes payments businesses great. If you look at the stock charts of Visa and companies like that, you'll see they've grown a lot over time because, they ride these waves of general inflation and general growth in commerce over time in global economies. So that certainly will be a tailwind at some level. Now, as we move over to Braintree, we think about the B2B business. How can that business continue to grow? We know it's been growing at pretty good rates, in excess of 20% in some of the prior quarters, probably slowing down a little bit, but there's still a lot of global expansion to be had. For PayPal, there are a lot of global large businesses that they probably haven't even really tried to sell into. That will offer a runway for growth. And of course, the enterprises themselves will hopefully grow. If you think about, the Ubers and the Airbnbs of the world, hopefully as they continue to grow over time, as the transaction processor, Braintree can grow its revenues via their clients as well. PayPal has also talked about Braintree having the opportunities to do more ancillary services. And this is really important because this is where you could get a lot of margin improvement. So PayPal building out more products to help businesses with things like chargebacks and fraud, FX conversions, and just a lot of the things around the payment sphere where maybe PayPal hasn't had as robust of a product suite. As they continue to build that out, they may be able to have add-ons and higher margin products that they can sell into these large enterprises. And then, of course, Braintree could potentially raise their take rates over time, although there is pretty heavy competition still from Adyen and Stripe in the B2B processing space. It may be difficult for Braintree to raise prices, but Alex Chriss, the new CEO, has hinted at potentially trying to do that at some point, at least with some clients, as some of the older contracts come up for renewal. Now let's talk about Venmo. Venmo, one of the most undermonetized assets at PayPal. Of course, we could continue to see transaction volume growing just because more and more people use it. And then PayPal is going to try to make Venmo more available. We've seen pay with Venmo buttons start to pop up. They did have pay with Venmo on Amazon, although just recently it was announced that Amazon may be removing it, likely because not that many people were using Venmo to pay on Amazon. But there is still potential for other e-commerce sites to potentially see if pay with Venmo becomes helpful to them and helps them increase their conversion rate. And I'm sure there are a lot of people that would be willing to use their existing Venmo balances to pay for things on e-commerce sites. PayPal just needs to do a better job of expanding the pay with Venmo availability. Another thing that Venmo is focusing on is teens. PayPal and Venmo have rolled out the Venmo teen accounts, which is really a great way to have teens and early users start using your product at a young age. They offer these debit cards that are associated with these accounts, and they really help to get these customers into the ecosystem at an early age. I don't know how well teen accounts will monetize. Historically, we've seen teen bank accounts not monetize very well, but later on in life, this is a longer term play certainly for Venmo. Venmo also has existing credit and debit cards that I think, if they continue to focus on penetration, I'm not sure really how well these can compete against large reward cards like your Chase Sapphires and Amexes of the world, but maybe Venmo can start to carve out a little bit more market share there. And then, of course, you have things like crypto. This is really not a big business for PayPal today, and PayPal has their own stablecoin, PYUSD, really doesn't do a lot of volume right now. But potentially, as crypto grows, Venmo and their PYUSD could have more volume run through that if they really start to add more features. I think they probably are behind things like Cash App and Robinhood and just the crypto native ecosystem itself. But potentially, if they were to focus more resources and crypto becomes more dominant and people actually utilizing it for day-to-day transactions, this is an area where PayPal does have a lot of potential where they're probably not earning much at all today. Now, it's not necessarily something I would make a high probability bet on, but again, it's maybe a little bit of a call option in PayPal's back pocket. Then, of course, Venmo could also increase take rates on certain transactions or expand the types of transactions that Venmo actually charges a fee on, although they have to be careful with this because they don't want to alienate the customer base and actually have customers delete the app if they feel like they're being ripped off by Venmo. All right, let's quickly recap the bear and bull arguments here on PayPal. Bears would say that PayPal's core business is under attack from competition like Apple Pay, Google Pay, and others. Therefore, it will struggle to grow. In fact, it will probably shrink. They would also say that although Braintree and Venmo are under-monetized, they will struggle to increase monetization because of competition in those business units from Adyen and Stripe on the Braintree side and Cash App and other peer-to-peer apps on the Venmo side. Overall, bears would say that PayPal, the company, is a melting ice cube. It's going to be very unlikely to grow revenues and profits. And in fact, they're likely to see profits decline in the years ahead. Therefore, they believe that PayPal stock deserves a very low multiple on today's current earnings figure, and PayPal is essentially a value trap. Now, bulls would counter and say that PayPal can overcome these challenges. They would say that PayPal can continue to grow. Even though growth rates have decelerated, they believe they can sustain 8 to 10% revenue growth in the years ahead by increasingly monetizing the under-monetized apps, Braintree and Venmo. They're also focusing on increasing innovation in the core business to try to reverse the declines. In fact, the new CEO, Alex Chris, has launched what he calls Project Quantum Leap to add new features rapidly to the core business to try to compete more effectively in the market. Bulls would say that there's room for profit margins to continue to expand in the years ahead, not only from growth, but also further efficiencies and cost cuts. Add on buybacks to that, they believe that earnings per share and cash flow per share growth can be 10% or above in the years ahead. And they would also say that the Braintree division alone makes up more than the entire market cap of the business if you were to value it like its competitors are valued. So let's put some numbers to these narratives, shall we? Let's start by looking at Braintree. If you'll recall, I estimated Braintree is generating somewhere around 25% of PayPal's total revenue today. PayPal as a whole is generating around $30 billion of annual revenue this year. That implies Braintree is doing somewhere between $6 to $8 billion of annual revenue. Now, Braintree has two major competitors, Adyen and Stripe. Stripe is private and Adyen is public, but Stripe also announces their fundraising rounds publicly. In their most recent fundraising round in March of 2023, they raised $6.5 billion at a $50 billion valuation. It's also been reported that Stripe is processing currently north of $800 billion of annual payment transactions, and that Stripe is generating somewhere around $14 billion or north of $14 billion of annual revenue. So if we take the $50 billion valuation divided by the $14 billion estimated revenue, Stripe is getting an implied valuation of somewhere around 3 times market cap to sales. Now, Adyen is public, and Adyen is doing about $1.5 billion of annual revenue, with very, very high EBITDA margins, almost 50% EBITDA margins, so very, very profitable. And Adyen's valuations are very high currently. Adyen is currently trading at around 15 times next year's estimated annual sales. Very, very different than Stripe, but of course it's very, very profitable. It's also trading north of 40 or 50 times earnings estimates. So very, very interesting to see that, a very wide range, but this can help us to maybe zero in on what Braintree standalone would be worth. Assuming again, somewhere between 6 and 8 billion with perhaps some upside in revenue in the years ahead, we can look at different levels of Braintree annual revenue and take a revenue multiple. Again, Stripe at the low end around 3 times, Adyen on the high end around 15 times. If we take the low end, we're still getting values for Braintree at perhaps around 20 billion or so, which is about a third of PayPal's current market cap. On the high end, we get values that are way more than PayPal's entire market cap just for the value of Braintree alone. In some of these scenarios, we're seeing 80 to 100 billion or more of value just for Braintree. Now, I would probably still tend towards the lower end because Braintree, like Stripe, is probably a lot less profitable than Adyen, but Braintree in the years ahead may be able to increase their margins at least to a level that's a little bit closer to what Adyen is generating today. So I do think there is a bull argument here that Braintree is being undervalued as being part of PayPal as a whole. Now, what about the other parts of the business? We can also take low-end and high-end valuations and get scenarios for those as well. The core PayPal checkout/wallet business is generating most of PayPal's earnings and cash flow today. So it could be generating somewhere around 3 or 4 billion of annual cash flow or earnings. And if you take the low end, if you take a multiple that's even below where the company as a whole trades today, you might get somewhere around 20 or $30 billion for the low end valuation there. On the high end, if you give it a low teens or mid-teens multiple on the 3 or 4 billion of annual earnings, you could get a value for the core business today, assuming you're pretty positive on it in the future, that looks around maybe 75 billion. Some people might even believe higher than that. Now, Braintree, we might take at the low end 15 billion, at the high end 75, kind of in that range that I showed you a minute ago. Venmo, though, also has a very wide range. Venmo is an interesting business, 90 million global users, very strategic. Some analysts have estimated Venmo might be worth as much as 40 billion or more. That seems a little bit aggressive. We know that Venmo is probably generating $1.5 billion or 2 billion of annual revenues today, with potential to generate a lot more in the future. but this would be a very, very high revenue multiple. Today, its larger competitor, Square/Block, which owns Cash App, that entire company is trading just under 2 times market cap to sales. Now, it has traded in the teens. It has traded at more like an Adyen multiple in the past, but currently is trading at around 1.8 times market cap to sales. Of course, Square/Block does have other businesses beside Cash App, but it helps us to maybe give us an idea of what the potential range could be for Venmo. I took a stab at this. I think Venmo at the low end, using a Square-like multiple, might be worth $5 billion. At the high end, though, if you're more bullish and you think it's a more strategic asset that would fetch a much higher price, maybe a 10 times revenue multiple, it could be worth $20 billion at the high end. We can also add in the bull case, some values for things like Honey, which could at some point be sold, or maybe PayPal will eventually do something with it and create value out of it. You know, they spent $4 billion on it. You would hope that they could generate something. We can also add in the net cash and investments, the $4.5 billion or so on PayPal's balance sheet. And that'll give us an implied market cap, and we divide by the share count to get an implied value per share. On the low end, you can get downside from today's stock price. Not a ton of downside, but still some downside. On the high end, you might think that PayPal could more than double from here, which is very interesting. Now, can we actually use the sum of the parts valuation to assume that this is realistic? Like that we could actually, realize this value? Probably not. PayPal is very unlikely to spin out any of these divisions anytime soon. They've got a new CEO, and the CEO is focused on increasing the monetization of those businesses and the potential and the growth of those businesses within overall PayPal. He probably doesn't want to get rid of them just yet. They're not really earning their potential at the moment. So very unlikely that we would actually realize this sum of the parts valuation, but we can think about PayPal's valuation as the total company as well. I usually like to use free cash flow multiples and multiply, the free cash flow or the free cash flow per share that a company is going to generate in the years ahead, multiply it by a multiple. But PayPal's cash flow is a little bit noisy lately. Their cash flows are being affected by the fact that they're selling some of their buy now, pay later loan portfolios to a private equity firm. So it's a little bit noisy. We can use earnings figures, which are a little bit more smoothed out, even though they're accounting based. But I actually like to make adjustments to the earnings numbers as well. I like to exclude things like restructuring charges and stock-based compensation, because the way that I adjust for stock-based compensation is to adjust the share count. I adjust it by looking at the dilution and the rate of dilution. Of course, PayPal is actually buying back a lot of stock right now, so they're fully offsetting the dilution from issuing shares to employees. Now, that may not continue forever, but in any case, I use adjusted earnings per share figures, and we can use different earnings multiples to get an implied stock price. So I've done that here in the table, and you can see that if you use a bearish multiple, a multiple that's even lower than today, a multiple that's typically reserved for companies that are shrinking, and you assume the earnings will decline for PayPal, then you can get downside, pretty significant downside of the stock price, maybe down into the $30 or $40 range. However, my personal opinion is that PayPal should be able to keep earnings at least flattish over the next couple of years in this transition, where they're maybe losing some earnings in the core business, but they're offsetting that by increasing monetization at Braintree and Venmo. Yes, I believe they'll be successful in doing that to some degree. And I do think that PayPal should be able to keep earnings flattish, if not grow them a little bit. I would also probably give PayPal a little bit better multiple. So I do think there's pretty significant upside potential for PayPal stock into perhaps the $80 or above range. But you can make your own estimates here. Now, I will note, of course, that the Wall Street analysts out there currently estimate PayPal will grow earnings at 10 to 12% over the next several years. So they think that PayPal will be generating north of $5 and $6 of earnings in the next 2 years. And of course, if you were to give it a market multiple, the average large cap stock is trading at about 18.7 times next year's earnings estimates. This would give PayPal stock values well into the hundreds. So it's worth noting that's more the bullish case. I'm probably somewhere in the middle. Like I said, I'm probably a little bit more cautious given the core business struggles. But I still think that the risk reward is probably skewed, especially when you're talking about PayPal stock when it's trading at its annual lows around the $49, $50 range. It seems like there's a little bit more skewed potential to the upside than to the downside when it's at that level. So personally, I do own some PayPal stock. I bought some recently in the 50s and low 60s range, but it's a small position size for me, less than 3% of my overall portfolio. And the reason that I sized it conservatively is because I still want to see management prove that they can reverse the decline in transaction margin. I still want to see management prove that they can offset the challenges in the core business with growth in other areas of the business. Apple Pay is a stiff competitor. That user experience is really good. I've been using it a lot more. Now, I would probably buy more of the stock if I do see that the core business is stabilizing and other parts of the business are growing rapidly. I might sell the stock if I see the core business decline more than I expected. So I'm going to keep monitoring the fundamentals quarter by quarter. By the way, I always share my up-to-date thoughts with members of the Skill Incubator community. So if you're interested in joining, I'll link that below. But let me know your thoughts on PayPal. Let me know if I overlooked anything major. Let me know if you think it's an interesting stock. As always, you got to do your own research and make your own financial decisions. But let me know what you think, and I will see you in the next video. Cheers.